We all interact with interest rates every single day. We feel their effects in the size of a mortgage payment, in the small print of a savings account, in the monthly bill from a credit card, in the quiet calculation a business owner makes before deciding whether to open a new location. We hear about them on the news, delivered with a strange gravity, as though a single number, announced by a handful of people in a room, could genuinely ripple outward into every corner of daily life. And in a way it can, but almost none of us were ever taught what an interest rate actually is. Not really. Not the deeper mechanism underneath the number. The gap between what we experience and what this quiet, constant force is actually doing, that is what we are going to walk through tonight. But let us start somewhere closer. Right here, in the world you live in, at this moment. Let us begin with the simplest possible way to describe an interest rate, and then slowly add the layers that make it genuinely interesting. An interest rate is the price of money over time. That is really the whole of it, condensed into a single sentence. When you borrow money, you are not simply receiving a sum of currency. You are receiving the use of that money now in exchange for a promise to return more of it later. The difference between what you borrow and what you eventually repay is the price you pay for being allowed to use someone else's money before you had earned or saved it yourself. And when you lend money, or deposit it in a savings account, or buy a bond, you are doing the reverse. You are giving up the use of your own money now in exchange for a promise that you will receive more of it back later. The interest rate is simply the exchange rate between money today and money in the future. This single idea, money now is worth more than the same amount of money later, sits underneath everything we are going to explore tonight. And it is worth sitting with for a moment because it explains something that otherwise feels almost arbitrary. Why should waiting cost anything at all? Picture a simple choice. Someone offers you a certain amount of money today, or that exact same amount of money, in the exact same currency, 1 year from now. Almost everyone, given this choice, prefers the money today, even setting aside any worry about inflation eroding its value in the meantime. This preference is not simply impatience, though impatience is part of human nature too. It reflects something economists call the time value of money. Money available today can be put to use immediately. Invested, lent out to earn its own return, or simply held as a cushion against an unexpected need. While money promised for the future carries none of that immediate flexibility, and carries, in addition, some risk that the promise might not be honored exactly as expected. An interest rate is simply the price that reconciles this preference. It is the amount of extra money required to make waiting feel, to a reasonable person, just as attractive as having the money right now. Financial professionals use a formal version of this same idea, called present value, to calculate exactly how much a future payment is genuinely worth today. Once this preference for immediacy and the interest rate reflecting it are properly accounted for, the answer has several layers, and each one adds a little more texture to the picture. The first layer is opportunity cost. If you lend someone your money, you give up the ability to use that money yourself during the time it is lent out. You cannot spend it, invest it, or hold it as a cushion against an unexpected need. An interest rate compensates you for that lost flexibility. Think of it as rent paid on your money, in the same way you might pay rent to use someone else's apartment. The money is not gone, it is simply unavailable to you for a while, and that unavailability has a price. Consider for a moment what you might have otherwise done with the sum of money you choose instead to lend out. You might have used it to cover an unexpected expense without needing to borrow yourself. You might have invested it in your own small venture, or simply kept it accessible, offering a quiet sense of security, simply by being there if needed. Every one of these alternative uses represents a kind of value you are setting aside the moment you agree to lend the money to someone else instead. The interest you receive in return is not a bonus or a reward in any moral sense. It is, quite specifically, compensation for the specific alternatives you gave up during the period the money was out of your hands, which is precisely why economists reach for the term opportunity cost, rather than simply calling it a fee. It is the cost of the next best opportunity you set aside in order to make the loan possible at all. The second layer is risk. Whenever you lend money, there is some possibility, however small, that you will not be repaid in full, or on time, or at all. A lender demands a higher rate from a borrower who seems less likely to repay reliably, and a lower rate from a borrower who seems highly likely to repay without difficulty. Picture two friends each asking to borrow the same amount of money from you. One has a steady job, a long history of paying back small favors reliably, and a clear plan for how the money will be used and repaid. The other has an unpredictable income, no particular track record with you, and a vaguer sense of when repayment might happen. Even between friends, most people would instinctively feel more comfortable lending to the first person than the second, and if you were somehow going to charge a fee for the loan either way, you would almost certainly charge the second friend more, simply to compensate yourself for the greater uncertainty involved. Banks and bond markets are, at their core, doing exactly this same instinctive calculation, just formalized into a specific percentage, applied consistently across millions of borrowers rather than two friends at a kitchen table. This is why a government widely regarded as financially stable can typically borrow at a lower rate than a small business just getting started, and why that small business, in turn, can typically borrow more cheaply than an individual with an unpredictable income and no established credit history. The rate is not a judgment of someone's character. It is a mathematical reflection of uncertainty priced into a number. This same layer of risk operates at the scale of entire nations, not just individual borrowers, and it explains a great deal of the international financial news you may have encountered without quite grasping the mechanism behind it. There is a related international dimension worth understanding, because it explains why interest rates differ so noticeably from one country to another, even between countries with broadly similar economic stability. Since each currency has its own separate policy rate, set by its own central bank responding to its own domestic conditions, two countries can have meaningfully different rates at the very same moment, even if both are considered financially reliable. This difference creates an incentive, well known to international investors, to borrow in a currency with a low rate and invest the proceeds in assets denominated in a currency with a higher rate, an arrangement sometimes called a carry trade. This flow of capital, chasing the difference between national rates, is itself one of the forces that helps keep interest rates across different countries from diverging too wildly or too permanently, since large enough flows of capital tend to gradually influence exchange rates and borrowing conditions in ways that narrow the original gap somewhat, though rarely eliminating it entirely. This is one more thread connecting the seemingly separate, contained decision of a single central bank to the wider, deeply interconnected web of global lending we have been describing all evening. When investors lend money to a national government by purchasing its bonds, they charge a rate reflecting their confidence that the government will honor its obligations reliably on schedule. In a currency that will retain its value, governments with long, stable track records, diversified economies, and credible institutions typically borrow at lower rates than governments perceived as carrying greater political, economic, or currency risk. This gap between what different governments pay to borrow the same amount of money in some cases, even in the same currency, is called sovereign risk premium. And it can shift, sometimes rapidly, as investors update their assessment of a country's stability, offering a real-time, continuously updating signal of how the wider financial world currently views a nation's prospects. This dynamic was on vivid historic display during the European sovereign debt difficulties of the early 2010s, when several countries sharing the same currency, and therefore unable to rely on a difference in currency risk to explain any gap between them, nonetheless saw the rates on their government bonds diverge dramatically from one another within a very short span of time. As investors grew increasingly worried about the ability of certain governments to manage their existing debt burdens, countries perceived as more fiscally stable continued borrowing at low rates throughout the episode, while countries perceived as more vulnerable saw their borrowing costs rise sharply, sometimes within a matter of weeks, even though all were using the same shared currency and, on paper, operating under the same broader monetary framework. This episode illustrates something worth remembering. Sovereign risk premium is not simply a reflection of a currency's stability, since currency itself was identical across every country involved. It reflects a market's ongoing, continuously updated judgment about the specific fiscal and institutional reliability of each individual borrower, quite separate from whatever currency that borrowing happens to be denominated in. At the individual level, this same underlying logic determines the specific rate quoted on your own mortgage, car loan, or credit card, largely through the mechanism of a credit score, a number calculated from your personal history of borrowing and repayment that lenders use as a shorthand estimate of how reliably you are likely to repay a new loan. A higher score signals lower perceived risk, and lenders reward that lower risk with a lower rate, following exactly the same underlying logic that separates a stable government's borrowing cost from a struggling company's or a struggling nation's. This is worth remembering because it means the rate quoted specifically to you is not a personal judgment handed down from an anonymous institution, but the same universal risk formula we have been describing all evening, simply applied at the scale of a single household rather than an entire nation. The third layer, and the one most people have heard about without quite understanding, is inflation. If you lend someone 100 units of currency today, and prices are expected to rise before you are repaid, the money you receive back will buy less than the money you lent out, even if the exact same number is returned to you. Lenders account for this in advance, building an expectation of future inflation directly into the rate they charge, so that the return they receive still represents a genuine gain in real purchasing power, not simply a larger nominal number that buys the same amount or less than before. This relationship has a name economists use constantly. The nominal interest rate is, roughly, the real interest rate, the actual gain in purchasing power, plus the expected rate of inflation over the period of the loan. When you hear a bank advertise a 5% rate and inflation is running at 3%, the real return being offered is closer to 2%. And this distinction between the nominal number on the page and the real value underneath it explains an enormous amount of financial confusion that most people never have properly untangled for themselves. There is one more mechanical relationship worth understanding early, because it resolves a piece of financial news that confuses a great many people the first time they encounter it. The inverse relationship between interest rates and the price of existing bonds. Imagine you hold a bond that pays a fixed amount of interest each year. If prevailing interest rates in the wider economy rise after you bought it, new bonds being issued now offer a higher, more attractive payment than yours does. To sell your older, less generous bond to someone else, you would need to offer it at a discount, a lower price, to compensate the buyer for accepting your bond's comparatively smaller interest payment instead of a newer, more generously paying one. This is why rising interest rates cause the market price of existing bonds to fall, and falling interest rates cause the market price of existing bonds to rise. An inverse relationship that surprises people, expecting rates and prices to move in the same direction together, simply because the words rate and price both sound like they should describe the same kind of increase or decrease. Layered together, these three elements, the price of waiting, the price of risk, and the price of expected inflation, combine to produce the rate you see quoted on a mortgage, a savings account, a government bond, or a business loan. Different rates for different situations are not arbitrary or unfair. They are the same underlying formula applied to different levels of weighting, different levels of risk, and sometimes different expectations about the future, held by different lenders looking at the same borrower from slightly different angles. It is worth pausing here to notice how elegantly these three layers combine, because the elegance itself is part of why this single formula has proven so durable across so many centuries and so many different economic systems. A very short loan to a very reliable borrower during a period of very low expected inflation will carry a very low rate, since all three layers are, in effect, contributing very little to the final number. A very long loan to a less certain borrower during a period of considerable inflation uncertainty will carry a correspondingly higher rate, since all three layers are now contributing meaningfully at once. Nearly every rate you will ever encounter in ordinary financial life, from a friendly personal loan to a government bond auction watched by investors around the world, is simply some particular combination of these same three ingredients mixed in different proportions depending on the specific circumstances of the specific loan in question. There is a particular kind of interest rate that receives more attention than any other, and it deserves a clear explanation here before we go any further. The policy rate set by a central bank, sometimes called the base rate, the federal funds rate, or the discount rate, depending on the country. This is not, strictly speaking, the rate you personally pay on a mortgage or receive on a savings account. It is a rate that applies specifically to short-term lending between banks themselves as they manage their day-to-day reserves. But this single rate acts as an anchor, a kind of gravitational center around which nearly every other interest rate in the economy tends to orbit. When a central bank raises this rate, borrowing becomes more expensive for banks, and banks in turn pass that higher cost along to the businesses and individuals who borrow from them in the form of higher mortgage rates, higher credit card rates, and higher business loan rates. When a central bank lowers this rate, the same chain runs in reverse, making borrowing cheaper throughout the economy. There is a subtlety here worth clarifying, because it resolves a common point of confusion whenever a central bank announcement is followed by headlines noting that mortgage rates barely moved, or even moved in the opposite direction. The policy rate we have been describing directly governs short-term borrowing between banks. A 30-year mortgage, by contrast, is a long-term commitment, and its rate tends to track more closely with the yield on long-term government bonds of similar duration, which reflects not just the current policy rate, but the market's collective expectation of where that policy rate is likely to go over the following years, plus the term premium we will describe shortly. This is why mortgage rates can sometimes rise in anticipation of a future policy change well before a central bank actually acts, and can occasionally fall even after a central bank raises its short-term rate, if that increase was already fully expected and priced in by longer-term lenders beforehand. The policy rate is the anchor, but the specific rate you are quoted on a specific loan is determined by a slightly longer, slightly more forward-looking chain of reasoning. running through the bond market before it ever reaches your own paperwork. Think of it as a set of brakes and an accelerator built into the engine of an entire economy. When central banks want to slow down an economy that feels like it is growing too quickly, overheating, generating rising prices faster than is comfortable, they raise this policy rate. Higher borrowing costs discourage businesses from expanding as aggressively, discourage individuals from taking out large loans for homes or cars, and generally cool the pace of spending throughout the system. When central banks want to encourage a sluggish economy to pick up speed, they lower the rate, making borrowing cheaper and encouraging exactly the opposite behavior. More expansion, more spending, more borrowing, more overall activity. A second, complementary way to picture this same mechanism is as a thermostat, quietly regulating the temperature of an entire economic system. A thermostat does not create heat directly or remove it directly. It adjusts the setting, and the furnace or the air conditioning responds gradually over time, bringing the room's temperature closer to the intended target, never instantly, always with some lag between the adjustment and the felt result. Interest rates work in much the same way. The policy rate itself is simply a setting. The actual warming or cooling of the wider economy happens gradually as millions of individual borrowing and spending decisions respond to that setting over the following months. This is why central bankers speak so often, almost repetitively, about patience, about waiting to see how a previous adjustment plays out before making another one. In the same way, a careful homeowner waits to feel whether a room has actually warmed before deciding whether to adjust the thermostat any further. This lever is one of the most powerful and most closely watched tools in the entire architecture of a modern economy. And it is precisely why a single announcement from a handful of people in a room can genuinely move markets, mortgages, and monthly budgets around an entire country, sometimes around much of the world at once. But to understand why this single number carries so much weight, and why it took human civilization thousands of years to arrive at the sophisticated system we now take almost entirely for granted, we need to go back. Not because history is interesting for its own sake, though it very often is, but because the present on its own does not fully make sense without it. It is worth pausing before we go there to notice just how much weight this single concept is asked to carry in a modern economy. The same basic idea, the price of waiting, sets the rate on a student loan helping a young person afford an education, the rate on a government bond funding a hospital or a bridge, the rate on a business loan helping a small company hire its first employees, and the rate on a mortgage helping a family settle somewhere they intend to stay for decades. A single mathematical relationship, refined and layered over thousands of years, quietly threads through almost every major financial decision a person or an institution will ever make. Understanding it properly, then, is not simply a matter of satisfying curiosity about an abstract economic mechanism. It is closer to understanding one of the load-bearing walls of the entire financial world you already live inside every day, whether you have ever paused to think about it or not. So, if interest is simply the price of money over time, how did human beings first arrive at the idea that waiting should cost something at all? And how did that idea evolve into the complex, interconnected system of rates that quietly governs so much of modern life? Some of the very earliest written records we have from human civilization already contain interest rates, calculated with striking precision. In ancient Mesopotamia, roughly 4,000 years ago, clay tablets recovered by archaeologists record loans of grain and silver between individuals and temples, with specific interest charges attached, often calculated at rates around 20% per year for silver and somewhat higher for grain, reflecting the greater risk and spoilage involved in lending a perishable commodity rather than a durable metal. These were not vague informal arrangements. They were precise, documented, legally enforceable contracts, complete with specified repayment schedules, and in some cases, penalties for late payment. This tells us something worth pausing on. The concept of charging for the use of money over time is not a modern invention layered onto human society by clever financiers. It appears to be almost as old as the written record itself, arising independently, it seems, wherever human beings began lending and borrowing at any meaningful scale. What is perhaps even more striking is that these same ancient societies were already grappling with the risks that unrestrained interest could pose, and were already experimenting with ways to contain them. The Code of Hammurabi, one of the oldest surviving legal codes, compiled in Babylon roughly 3,800 years ago, did not simply permit interest. It capped it, setting a legal maximum of around 20% annually on loans of silver and a somewhat higher maximum on loans of grain, reflecting the greater risk of a loan that could spoil, rot, or be destroyed before it was repaid. This is worth pausing on, because it means that the very first written interest rate rules we have from human history were not simply describing a free, unregulated price. They were already an attempt to balance the legitimate needs of lenders against the real danger that excessive rates could trap borrowers in debts they could never realistically repay. That danger was real enough and recurring enough that several ancient Mesopotamian rulers periodically issued what are now called debt jubilees, formal royal decrees canceling certain categories of accumulated debt, particularly debts owed by farmers and ordinary households, resetting the system periodically before excessive debt burdens could destabilize the wider economy or the social order underpinning it. These jubilees were not issued out of simple generosity. They reflected a very old, very practical recognition that a lending system, left entirely unchecked over a long enough period, tends to concentrate obligations in ways that eventually threaten the stability of the entire society built on top of it. This is, in miniature, a genuinely ancient version of attention that still exists today. In modern conversations about consumer debt protection, bankruptcy law, and the appropriate limits on how aggressively a lender can pursue an unpaid debt, the ancient world did not universally embrace this practice without tension, however. In ancient Greece, the philosopher Aristotle argued that charging interest was, in his words, an unnatural use of money, since money, in his view, was meant to facilitate the exchange of goods, not to breed more money simply by existing and being lent out. This philosophical objection to interest, sometimes called usury, when charged at rates considered excessive or exploitative, would echo forward for well over 1,000 years, shaping law and religious doctrine across multiple civilizations. For much of the medieval period in Europe, the Catholic Church treated the lending of money at interest as a serious moral offense, and various Islamic legal traditions developed and continue to maintain today sophisticated alternative financial structures designed to facilitate investment and risk sharing without relying on a direct, fixed interest charge in the way modern Western banking typically does. This long philosophical and religious debate is worth remembering because it shows that interest rates were never merely a neutral mathematical tool. For most of human history, the very idea of charging for the passage of time was treated as a genuine ethical question, not simply an accepted feature of commerce. It was in this environment of moral restriction that European merchant bankers, including the Medici family of Renaissance Florence, developed increasingly creative financial instruments specifically designed to generate a return on lent money without technically being classified as forbidden interest under church law. arrangements involving currency exchange across different cities, delayed payments structured as a fee rather than interest, and shared risk in a trading venture achieved much the same practical economic effect as a straightforward interest-bearing loan, while satisfying the letter of religious restriction. If not always its full spirit, the Medici Bank, in particular, built an extensive network of foreign exchange transactions across different European cities, embedding what amounted to interest charges directly into the exchange rates quoted between currencies. A technique clever enough that it took centuries for the underlying economic reality to be fully separated in most people's minds from the letter of the law religious permission that made it possible. One of the more remarkable stories to emerge from this era involves a financial instrument that still exists today in a way that few people realize. In 1648, a Dutch water authority responsible for maintaining dikes along the Lek River issued a bond to raise funds for repair work, promising to pay a small annual amount of interest to whoever held the bond, indefinitely, with no fixed repayment date. This kind of bond, called a perpetuity, was not unusual for its time. What is unusual is that this particular bond survived, changed hands many times over the following centuries, and continued paying interest in gradually adjusted amounts all the way into the 21st century, when it was finally purchased by a university for its collection, having paid interest continuously for well over 350 years. This single, surviving document is a genuinely striking illustration of what an interest rate actually represents at its core. Not a modern abstraction, but a durable, centuries-spanning promise, honored across generations. Dynasties, currencies, and entire political systems, precisely because the underlying institution behind it, in this case, a regional water authority responsible for keeping the land dry, continued to exist and continue to honor its word. This period in Amsterdam produced another innovation that deserves mention because it created the environment in which interest rates could be observed, compared, and traded openly, rather than negotiated privately behind closed doors. The Amsterdam Stock Exchange, established in the early 17th century, originally to trade shares in the Dutch East India Company, gradually became a marketplace where government and municipal bonds, each carrying its own interest rate, could be bought and sold freely among the public. For the first time in a systematic, visible way, interest rates became something the public could observe directly, compare across different borrowers, and respond to as conditions changed, rather than something known only to the individual lender and borrower involved in a private transaction. This shift, interest rates moving from private, individually negotiated arrangements toward a publicly visible, continuously traded price, is one of the quiet foundations of the modern financial world. And it is part of why, centuries later, a change in a single policy rate can be observed, reported, and reacted to by millions of people within minutes of being announced. There is an earlier, less well-known chapter to this same story, worth adding before we reach Amsterdam, because it shows that the idea of trading government debt as an ongoing, income-generating asset stretches back considerably further than the Dutch canals. The Republic of Venice, beginning as early as the 12th century, financed its wars and its trading ventures through a system of forced loans imposed on its wealthier citizens called prestiti, which paid a regular annual interest rate and, crucially, could be bought and sold among Venetian citizens on an active secondary market, allowing someone who needed cash before the loan's eventual repayment to sell their claim to another citizen instead of simply waiting. This meant that Venetian government debt functioned in practice remarkably similarly to a modern government bond, complete with a market price that rose and fell based on the Republic's perceived financial health and military fortunes at any given moment. centuries before Amsterdam formalized and expanded the same basic idea into the more familiar exchange we described a moment ago. Venice's prestiti are a reminder that nearly every seemingly modern financial innovation we take for granted today, when traced back far enough, tends to reveal an earlier version, often centuries older, solving essentially the same problem with the tools available at the time. Let us bring the thread forward to the birth of the institutions that manage interest rates deliberately at the scale of an entire economy, rather than leaving them purely to the private negotiations between individual lenders and borrowers. The Bank of England, founded in 1694, gradually developed the practice of setting a specific rate at which it would lend to other banks, called the bank rate, using it as a lever to influence the broader availability and cost of credit throughout the British economy. For much of the 19th century, this rate was adjusted based largely on the flow of gold in and out of the country, under the gold standard. Since maintaining the fixed convertibility of currency into gold required careful management of how attractive the currency was to foreign lenders and depositors. A higher bank rate made deposits in London more attractive to foreign capital, helping to defend the currency's gold backing during periods of strain, and a lower rate did the reverse. This early history matters because it shows that setting interest rates deliberately as a tool of national economic management rather than simply a private transaction between two parties is itself a relatively recent institutional invention, barely more than a century and a half old in its modern form. The United States arrived at a similarly deliberate system somewhat later, following the establishment of the Federal Reserve in 1913. In the aftermath of a series of severe banking panics that had repeatedly demonstrated the dangers of a large, interconnected financial system with no central authority capable of adjusting the cost and availability of credit during moments of genuine crisis. Over the following decades, the tools available for adjusting interest rates gradually expanded and became more sophisticated, moving well beyond a single simple lending rate toward the layered, multi-instrument system central banks use today. This early deliberate use of the bank rate as a tool of national policy created a genuinely delicate balancing act under the gold standard, one worth understanding clearly because it explains a tension that echoes forward into every modern debate about interest rates. Raising the bank rate protected a currency's gold backing by attracting foreign capital, but it also slowed domestic economic activity, since higher borrowing costs discouraged businesses and households at home just as much as they attracted lenders from abroad. Central bankers of this era were, in effect, forced to choose repeatedly between defending the currency's fixed value and supporting the domestic economy, since a single rate could not fully serve both goals at once. Whenever the two came into conflict, this same fundamental tension, a single tool, multiple competing goals, no way to fully satisfy all of them simultaneously, remains one of the defining unresolved challenges of interest rate policy today. Dressed in modern clothing but structurally unchanged from the dilemmas facing a 19th century central banker in London, the development of mortgage lending in the United States offers another instructive chapter in this history because it shows how a single design choice about interest rates can reshape an entire society's relationship with homeownership. Before the 1930s, most American mortgages required a large down payment, carried a short repayment term of only a handful of years, and typically demanded a single large final payment to fully retire the loan, an arrangement that left many households vulnerable during the Great Depression. When this final balloon payment came due at precisely the moment jobs and incomes had collapsed across the country. In response, government-backed reforms during this period helped popularize the long-term, fixed-rate, fully amortizing mortgage, a loan structure where the interest rate is locked in for the entire duration, often 30 years and each monthly payment steadily reduces both the interest owed and the underlying principal until the loan is fully repaid without any large final balloon payment required. This single design choice, embedding a fixed interest rate for an extraordinarily long period, transformed homeownership from a comparatively risky short-term arrangement into the stable, predictable, multi-decade commitment that most people today simply assume a mortgage has always been. But locking a rate in place for 30 years creates its own risk, one that took decades to fully reveal itself, and which produced one of the more instructive financial crises of the 20th century. Savings and loan institutions across the United States, specializing in exactly these long-term fixed-rate mortgages, funded those loans using short-term deposits from ordinary savers. This arrangement worked smoothly as long as short-term rates remained low and stable. But when inflation surged in the late 1970s and Paul Volcker's Federal Reserve pushed short-term rates dramatically higher to fight it, these institutions found themselves in a painful mismatch. They were still receiving low, fixed interest payments on decades-old mortgages issued years earlier, while simultaneously being forced to pay much higher rates to attract and retain the short-term deposits funding those very mortgages. Hundreds of savings and loan institutions across the country failed or required government intervention over the following decade, in what became known as the savings and loan crisis. The lesson embedded in this episode is one that still shapes financial regulation today. An interest rate promise, once made for a long enough period, can quietly become a serious source of risk if the world around that promise changes in ways the original agreement never anticipated. This history, though, reaches perhaps its most dramatic and instructive modern chapter in the story of the late 1970s and the decision made by Paul Volcker, who became chairman of the United States Federal Reserve in 1979. Facing a decade of steadily rising, deeply entrenched inflation that had proven remarkably resistant to more modest, incremental adjustments, Volcker made a decision that remains, to this day, one of the most consequential and controversial uses of interest rate policy in modern economic history. He raised the federal funds rate dramatically, at one point pushing it above 19%, deliberately making borrowing extraordinarily expensive throughout the entire economy. Specifically, in order to break the cycle of rising prices and rising inflation expectations that had become deeply embedded in American economic behavior over the preceding decade. The immediate consequences were severe. Mortgage rates for ordinary homebuyers climbed above 18% in some cases. Businesses across the country postponed or canceled expansion plans. Unemployment rose sharply, and a painful recession followed. But inflation, which had seemed almost unstoppable throughout the 1970s, did eventually fall substantially. And this single, deliberately painful use of the interest rate lever is still studied today as the clearest demonstration of just how powerful and just how costly this particular tool can be when used at its full strength. Volcker's dramatic rate increase did not stay contained within American borders. Throughout the 1970s, many developing nations, particularly across Latin America, had borrowed extensively from international banks at variable interest rates, often denominated in US dollars, to fund industrial development and infrastructure. When the Federal Reserve pushed American rates to nearly 20%, the cost of servicing these existing loans rose dramatically, and almost overnight, for borrowing governments that had no direct say whatsoever in the decision being made in Washington. Combined with falling prices for the raw commodities many of these countries relied on for export revenue, this sudden increase in borrowing costs triggered a wave of sovereign debt crises across the region, beginning in 1982. Starting with Mexico's announcement that it could no longer meet its scheduled payments, followed by similar difficulties across much of Latin America over the following years. This episode is worth holding on to because it demonstrates something genuinely important about interconnected global financial system. A decision made by a single central bank, addressing a specific domestic problem within its own borders, can ripple outward with tremendous force into economies and households thousands of miles away, who had no part whatsoever in the original decision, simply because so much of the world's borrowing, even by foreign governments, was, and often still is, denominated in a small handful of major global currencies. And then, starting around the late 1980s and continuing through the following decades, things began to shift again. Quietly at first, central banks around the world, having witnessed both the damage of unchecked inflation and the real cost of Volcker's cure, began developing more gradual, more transparent, more carefully communicated approaches to adjusting interest rates, relying increasingly on smaller, more frequent adjustments, rather than the kind of dramatic, blunt intervention Volcker had been forced into. New financial markets developed around the buying and selling of interest rate risk itself, allowing businesses and investors to hedge against future rate changes in increasingly sophisticated ways. The world we live in now, the one where a quarter-point adjustment to a single policy rate can be debated for weeks in advance, analyzed from every conceivable angle by economists and investors around the globe, was born in this period, out of the hard lessons of everything that came before it. Let us bring together everything we have gathered so far, the mechanism from earlier, and the history we have just walked through, because this is the point where they finally lock together into something you can actually use to make sense of the financial news. One of the most useful concepts in modern interest rate theory is something economists call the neutral rate, sometimes written as R star. This is, in essence, the theoretical interest rate at which an economy is neither being stimulated nor restrained by monetary policy, the rate at which borrowing and lending naturally balance with the underlying pace of real economic growth without either accelerating or decelerating it artificially. When a central bank sets its policy rate above this neutral level, it is deliberately applying the brakes, slowing the economy to cool inflation. When it sets the rate below this neutral level, it is deliberately applying the accelerator, stimulating growth. The genuine difficulty, and the reason this concept generates so much debate among economists, is that the neutral rate itself cannot be directly observed or measured. It can only be estimated, using models that rely on assumptions about the deeper structure of the economy, and those estimates shift over time, sometimes considerably, as the underlying economy itself evolves. This means that central bankers are, in a very real sense, aiming at a target they cannot see clearly, adjusting a lever based on their best estimate of a number that is fundamentally unobservable, a genuinely humbling situation for an institution responsible for something as consequential as the cost of money throughout an entire economy. There is also the matter of the yield curve, a concept that sounds technical but rests on an intuitive foundation. If you plot the interest rates on government debt of different maturities, a bond that matures in 3 months, one that matures in 2 years, one that matures in 10 years, and one that matures in 30, you typically get a curve that slopes gently upward, since lenders generally demand a higher rate to compensate for the greater uncertainty of lending money for a longer period of time, where more could conceivably go wrong before repayment. But on occasion, this curve inverts, meaning shorter-term rates rise above longer-term rates, an unusual and closely watched signal. There are 2 main competing explanations economists offer for why the yield curve slopes the way it typically does, and understanding both helps explain why an inversion is treated as such a significant, worrying signal when it occurs. The expectations theory holds that longer-term rates simply reflect the market's average expectation of what shorter-term rates will be, one after another, across the entire span of the longer bond's life, meaning a longer-term rate is essentially a forecast built by chaining together a sequence of anticipated shorter-term rates end to end. The liquidity preference theory, by contrast, holds that investors demand an additional premium for tying up their money over a longer period, regardless of any specific rate forecast, simply because longer commitments carry more uncertainty and less flexibility than shorter ones. An idea closely related to the opportunity cost layer we described earlier, applied specifically to the length of a commitment rather than the loan as a whole. Most modern economists treat the observed yield curve as reflecting some blend of both forces working together, rather than either one operating entirely alone, which is part of why interpreting a yield curve inversion is genuinely more subtle than simply reading it as a single, unambiguous forecast of trouble ahead. Historically, in many though not all instances, an inverted yield curve has preceded an economic slowdown or recession within the following 1 to 2 years, and this pattern has made yield curve inversions one of the most closely monitored indicators in modern finance. Economists continue to debate exactly why this relationship holds as reliably as it historically has, and whether structural changes in financial markets over recent decades might weaken its predictive power going forward, making this one of those areas where reasonable, well-informed people continue to disagree about how much weight the signal deserves in any given moment. There is also a genuinely fascinating mathematical property of interest rates, worth understanding clearly, because it explains why even small differences in a rate can produce dramatically different outcomes over long periods. Compounding. When interest is compounded, it is calculated not only on the original amount lent or saved, but also on the interest that has already accumulated in previous periods, meaning that growth accelerates over time rather than proceeding at a constant, steady pace. Picture a garden rather than a bank account for a moment. A single seed planted in the ground does not simply produce a single new seed the following season. It produces a plant, which produces many seeds, and if each of those seeds is planted in turn, the following season produces not one new plant, but many, and the season after that produces many more still, the growth accelerating with every cycle, rather than adding a fixed, steady number of new plants each time. Compounding interest works according to the exact same logic, translated from a garden into a ledger. The interest earned in the first year is added to the original amount, and the following year's interest is calculated on this larger, combined total, not simply on the original seed alone. This is why compounding is sometimes described, with only a little exaggeration, as one of the most powerful forces available in ordinary financial life, not because any single year's growth looks dramatic, but because the acceleration, left undisturbed over enough seasons, eventually produces a harvest considerably larger than a simple, uncompounded calculation would ever suggest. A helpful shortcut for understanding this is something sometimes called the rule of 72. Dividing 72 by an interest rate gives a rough estimate of how many years it takes for an amount of money to double at that rate. Compounding annually at a rate of 6%, money roughly doubles in 12 years. At a rate of 3%, it takes roughly 24 years to double instead. A genuinely large difference produced by what looks, on paper, like a fairly modest change in the underlying rate. This is precisely why even small adjustments to interest rates, sustained over long periods, can have such an outsized effect on the accumulated wealth of savers. the accumulated cost of borrowers, and the overall trajectory of an economy across a generation, even though the year-to-year change often feels almost imperceptibly small. It is worth naming, formally, the economist most closely associated with the relationship between nominal rates, real rates, and inflation that we described earlier. Irving Fisher, whose work in the early 20th century gave this relationship its lasting name, the Fisher effect. Fisher's insight, simple to state but genuinely powerful in its implications, was that lenders and borrowers, over time, adjust the nominal rates they demand and accept specifically to compensate for expected inflation, meaning that in a well-functioning financial system, real rates of return tend to be considerably more stable across long periods than the more visible nominal rates that fluctuate with each news cycle. A simple worked example makes this concrete. Imagine a lender who wants to earn a genuine 2% increase in purchasing power on a loan lasting 1 year, and who expects inflation over that year to run at roughly 4%. Following Fisher's logic, that lender would need to charge a nominal rate of approximately 6%, not 2%, so that after accounting for the eroding effect of 4% inflation, the 2% real return they were actually seeking remains intact. If inflation expectations later rise to 7%, with the same desired real return of 2%, the nominal rate charged would rise correspondingly to roughly 9%, even though the lender's actual underlying goal, a genuine 2% gain in purchasing power, never changed at all. This is part of why economists often prefer to look past the nominal number entirely when trying to understand the genuine underlying cost of borrowing, or the genuine underlying reward for saving, since the nominal figure alone, without knowing the inflation expectation embedded inside it, tells only half the story. There is also a further layer worth adding to the yield curve discussion from a moment ago: the concept of a term premium. The additional return investors generally demand for committing their money over longer periods, separate entirely from any specific expectation about future interest rate movements. Economists have long debated how much of the higher yield on long-term bonds reflects a genuine expectation that short-term rates will rise in the future, and how much simply reflects this separate compensation for the discomfort of tying up money for a longer, less flexible period. Two competing explanations, sometimes called the expectations theory and the liquidity preference theory of interest rates, have coexisted in economic literature for decades without one fully displacing the other. And most modern analysis treats the observed yield curve as some blend of both forces working together, rather than either one operating entirely alone. A related concept, worth understanding because it explains why a company or a country in financial difficulty pays noticeably more to borrow than a stable government does, even when both are borrowing at the exact same moment in the exact same currency, is the credit spread, the gap between a risky borrower's rate and the rate charged to the safest available borrower, typically a stable national government. This spread widens during periods of economic stress as lenders grow more cautious and demand greater compensation for perceived risk, and narrows during periods of confidence and stability, when lenders feel more comfortable extending credit without demanding as large a cushion. Watching how this spread widens or narrows over time gives economists a genuinely useful, continuously updated barometer of how anxious or confident the broader lending market feels at any given moment, often shifting well before slower-moving official statistics catch up to reflect the same underlying change in sentiment. It is also worth understanding a tool that operates alongside interest rate policy rather than through it directly: quantitative tightening. the reverse of the quantitative easing we described in relation to inflation. Rather than purchasing government bonds to inject money into the financial system, a central bank engaged in quantitative tightening allows previously purchased bonds to mature without reinvesting the proceeds, or in some cases, actively sells them, gradually withdrawing money from the financial system and putting additional gentle upward pressure on longer-term interest rates, working alongside rather than instead of changes to the shorter-term policy rate we described earlier. There is one further institutional point worth understanding, because it explains why interest rate decisions today are typically made by appointed committees operating with significant insulation from direct political pressure, rather than by elected officials responding directly to public opinion. Raising interest rates, even when clearly justified by underlying economic conditions, is rarely popular in the moment it happens, since it makes mortgages, business loans, and credit card debt more expensive for millions of people at once, producing real, immediate, keenly felt discomfort. Lowering rates, by contrast, tends to feel good in the short term, encouraging borrowing and spending, even when the underlying economic conditions might not fully justify it, and even when doing so risks fueling inflation further down the road. Elected officials, facing regular elections, face a structural temptation to prefer the popular short-term choice over the harder, longer-term one. This is precisely why so many countries, over the final decades of the 20th century, restructured their central banks to operate independently of direct political control, insulating specifically the interest rate decision from short-term electoral pressure, even while keeping the institution accountable to the public through legislative mandates, public reporting, and periodic testimony before elected bodies. Paul Volcker himself, it is worth noting, served under two presidents from different political parties across the span of his time at the Federal Reserve, continuing his painful, deeply unpopular rate increases across that transition, a continuity that would have been considerably harder to sustain without this deliberate institutional independence, protecting the decision from the shifting pressures of electoral politics. There is one further historical episode worth knowing, because it illustrates a genuinely different kind of risk connected to interest rates. Not the risk of a rate being too high or too low, but the risk of the rate itself being dishonestly reported. For decades, an enormous portion of global lending, from corporate loans to mortgages to complex financial contracts, was priced using a benchmark rate called LIBOR, calculated daily based on estimates submitted by a panel of major banks describing the rate at which they believed they could borrow from one another. In the years following the 2008 financial crisis, investigators discovered that several banks had for years deliberately submitted false estimates, manipulating the benchmark to benefit their own trading positions or to make their own financial health appear stronger than it actually was. This scandal, one of the largest of its kind in modern financial history, led to significant fines, criminal prosecutions in several countries, and the eventual, gradual retirement of LIBOR itself in favor of newer benchmark rates calculated directly from real, observable transactions rather than self-reported estimates. This episode is worth remembering because it is a reminder that even a number as seemingly technical and objective as a benchmark interest rate ultimately rests on human honesty, institutional oversight, and trust. The same ingredients that have underpinned every version of lending we have discussed tonight, from a Mesopotamian grain loan onward. There is a more recent chapter of this history worth knowing because it explains the specific kind of interest rate most people encounter most frequently in ordinary daily life: the credit card. The modern credit card traces back to 1958, when Bank of America mailed tens of thousands of pre-approved cards to residents of a single California city in what was, at the time, a genuinely experimental marketing effort. offering a revolving line of credit that could be used at a wide range of participating merchants, with any unpaid balance carrying forward month to month at a specified interest rate. This structure, revolving credit, available continuously rather than issued as a single lump sum, with interest charged only on whatever balance remains unpaid at the end of a billing cycle, was a genuine departure from earlier forms of consumer lending, which had typically involved a single, fixed loan repaid according to a fixed schedule. The convenience of revolving credit came paired, from the very beginning, with a correspondingly higher interest rate than more traditional forms of lending, reflecting both the unsecured nature of the debt and the greater administrative complexity of managing a continuously fluctuating balance across millions of individual accounts. This is worth remembering the next time a credit card statement arrives showing a rate considerably higher than a mortgage or car loan. The higher number is not evidence of a uniquely predatory product, but a fairly direct application of the same risk-based pricing logic we described at the very beginning of tonight, applied to a genuinely newer, more flexible, but also genuinely riskier form of lending than the longer, more established alternatives. There is a small, almost folkloric piece of vocabulary connected to the same period worth knowing, because you are likely to encounter it in ordinary financial conversation for the rest of your life. The prime rate. Originating in American banking practice earlier in the 20th century, this term originally referred, quite literally, to the rate a bank charged its most creditworthy, most reliable large corporate customers, its prime customers, reflecting the lowest risk premium the bank was willing to extend to anyone at all. Over time, the prime rate became a widely published benchmark, quoted in newspapers and referenced explicitly in countless loan agreements as a base figure, with individual borrowers typically quoted some amount above it, reflecting their own personal risk profile relative to that of the bank's most trusted corporate clients. The very name of the rate, still in everyday use today, quietly preserves the entire risk-based logic we described at the start of this evening. Somewhere, a rate exists for the safest possible borrower, and every other rate, for every other borrower, is measured as some distance above that baseline, exactly as it has been, in one form or another, for as long as lenders have needed a way to distinguish their safest customers from everyone else. Not every lending institution in history developed around the same profit-driven model. And it is worth knowing about an alternative tradition that emerged specifically in response to concerns about fair access to reasonable interest rates. Beginning in the early 19th century in Britain, and spreading through much of Europe and North America over the following decades, mutual savings banks and building societies were established with a structurally different purpose. Rather than being owned by outside shareholders seeking to maximize profit from the spread between what they paid depositors and what they charged borrowers, these institutions were owned collectively by their own depositors and borrowers, who shared in whatever surplus the institution generated, typically in the form of somewhat more favorable rates on both sides of the ledger than a conventional profit-driven bank might offer. Credit unions, which continue to operate on a similar cooperative model in many countries today, trace their roots to this same 19th century tradition, often specifically aimed at communities or professions that conventional banks of the era were reluctant to serve. This alternative history is worth knowing because it demonstrates that the relationship between a lender and a borrower has never been fixed to a single unavoidable structure. The core mathematics of opportunity cost, risk, and expected inflation remain the same regardless of an institution's ownership structure. But who benefits from the resulting spread between borrowing and lending rates has, throughout history, been a genuine matter of institutional choice, not an unavoidable law of economics. A further chapter of the mortgage story, arriving decades after the savings and loan crisis, deserves mention here as well, because it shows the same fixed versus variable tension reappearing in a new form. Beginning in the late 1990s and accelerating through the early 2000s, adjustable rate mortgages became increasingly popular among American lenders, often featuring an initially low introductory rate, sometimes called a teaser rate, that would later reset to a considerably higher rate tied to prevailing market conditions after a fixed initial period of 2 or 3 years. Many of these loans were extended to borrowers with limited credit history or income documentation, an arrangement that functioned reasonably well only under the assumption that home prices would continue rising steadily, allowing borrowers to refinance into a new, more favorable loan before their rate reset upward. When home prices stopped rising and then began falling, starting around 2006, many borrowers found themselves facing a reset to a considerably higher monthly payment on a home now worth less than the loan itself, with no ability to refinance their way out of the situation. This wave of resets, arriving simultaneously across an enormous number of loans, contributed significantly to the wave of mortgage defaults that helped trigger the broader 2008 financial crisis. This episode is worth remembering specifically for what it teaches about interest rates themselves, apart from the wider story of that crisis. An interest rate that is comfortable today can become considerably less comfortable at a specific, foreseeable future date, and a lending structure built on the optimistic assumption that refinancing will always remain available carries a specific, identifiable kind of risk. One that the savings and loan institutions of the 1980s and the subprime lenders of the 2000s each discovered, a few decades apart, in strikingly similar fashion. There is genuine ongoing debate among economists about several further aspects of this picture, worth being honest about rather than pretending the field is more settled than it truly is. One area of active discussion concerns why the neutral rate itself appears to have drifted lower across many developed economies in the decades following the 1980s, compared to the higher rates that prevailed throughout much of the 20th century. It is worth noting, too, that estimating the neutral rate is only one part of a broader, ongoing technical challenge central banks face, measuring in real time exactly how much slack or strain actually exists within a given economy at any given moment, since this assessment directly informs how far above or below the neutral rate a policy rate ought to sit. Indicators like unemployment, wage growth, business investment, and consumer spending all feed into this judgment, but each arrives with its own delays, revisions, and blind spots, meaning that a central bank is frequently forced to set a rate today based on an incomplete, sometimes later revised picture of an economy that may already have shifted by the time the fuller picture becomes clear. This is one more layer of the same honest humility we have tried to bring to this entire evening. Even with centuries of accumulated theory and increasingly sophisticated data, setting the exact right rate at the exact right moment remains in practice considerably more art than the tidy, confident number on the evening news might suggest. Various explanations have been proposed. An aging population in many countries, saving more for retirement and thereby increasing the overall supply of funds available to lend, slower underlying rates of productivity growth, reducing the return available on new investment, and shifts in global trade and capital flows all feature in different economists' explanations, without full consensus on how much weight each factor deserves. This debate connects to a broader, more provocative hypothesis, sometimes called secular stagnation, associated particularly with the economist Lawrence Summers, suggesting that developed economies may have entered a prolonged period in which the neutral rate remains persistently low, perhaps even uncomfortably close to zero, making it structurally difficult for central banks to stimulate a struggling economy using interest rate cuts alone. since there is comparatively little room left to cut before hitting the practical floor near zero. This hypothesis remains genuinely contested. Some economists point to the return of noticeably higher rates in the years following the disruptions of the early 2020s as evidence against a permanent structural decline, arguing instead that the earlier period of very low rates reflected temporary, specific conditions rather than a lasting new normal. Others maintain that the underlying long-term forces behind secular stagnation, demographic aging, slower productivity growth, remain firmly in place, and that the more recent rise in rates is itself the temporary deviation, not the earlier decades of low rates. This is, quite genuinely, an active, unresolved debate, one that will likely only be settled with the benefit of another decade or two of hindsight, the same way so many of the historical debates we have walked through tonight were only fully understood well after the fact. It is also worth knowing that the ancient tension between legitimate lending and exploitative lending, which we traced back to Hammurabi's Code and the moral debates of the medieval church, has never fully disappeared from modern law. Many countries and regions today maintain usury laws of their own, placing a legal ceiling on the interest rate that can be charged on certain kinds of consumer loans, particularly short-term, high-cost lending, sometimes called payday lending, aimed at borrowers with limited access to more conventional credit. These modern laws pursue essentially the same goal Hammurabi's scribes were pursuing 38 centuries ago: protecting borrowers, particularly the most financially vulnerable ones, from a rate so high that repayment becomes structurally difficult or impossible, while still allowing legitimate lending at a more moderate rate to continue serving a genuine economic purpose. The specific numbers have changed considerably. The underlying, very old concern behind them has not changed at all. Another area of active discussion concerns the effectiveness of very low or negative interest rate policies, which several major central banks experimented with extensively in the years following the 2008 financial crisis, particularly in Europe and Japan, in an attempt to stimulate borrowing and spending when conventional rate cuts alone no longer seem sufficient. Japan offers the longest and most closely studied example of this experiment, following the collapse of a dramatic asset price bubble in the early 1990s. The country's central bank lowered its policy rate close to zero and, for long stretches over the following 3 decades, kept it there, even venturing into negative territory for a period, in a sustained attempt to encourage borrowing, investment, and spending in an economy that remained persistently sluggish despite the extraordinarily low cost of money. The results of this multi-decade experiment have been genuinely mixed and are still actively studied by economists around the world. Growth did remain slower than many had hoped, even with borrowing costs held near zero for an extended period, suggesting that interest rates, however powerful a tool, are not always sufficient on their own to overcome deeper structural challenges facing an economy, including the same demographic aging that features prominently in the secular stagnation debate we discussed a moment ago. Japan's long experience with near zero rates is now treated by economists elsewhere almost as a preview or a cautionary case study, illustrating both the genuine limits of interest rate policy and the surprising durability of an economy that continues to function, if not always to flourish, even under conditions once considered highly unusual. It is also worth understanding, briefly, the more mechanical tools a central bank actually uses day to day to keep its policy rate near its intended target. Since the announcement of a rate decision is only the beginning of the process, not the whole of it, central banks primarily rely on something called open market operations, the routine buying and selling of short-term government securities with commercial banks, adjusting the amount of reserves available in the banking system on a continuous, largely invisible basis. To keep the rate banks charge one another, trading close to the officially announced target, central banks also typically set reserve requirements, specifying a minimum amount of deposits banks must hold in reserve rather than lend out. A lever that has become less central to day-to-day policy in recent decades than it once was, but which remains part of the broader toolkit available for managing the overall availability of credit throughout the banking system. None of this changes the underlying logic we described earlier. The brakes and the accelerator, applied to the pace of borrowing and spending throughout an economy. It simply reflects the fact that translating a single announced number into its intended effect across an entire banking system requires a continuous, largely unseen amount of technical maintenance, carried out quietly, every single business day by people whose job is specifically to make sure the visible number and the underlying reality stay aligned with one another. So what does all of this mean for us? Not for central banks and bond markets, but for the quiet daily life that most of us are actually living, lying here in the dark, thinking about a mortgage statement or a savings account balance rather than a policy committee's internal debate about the neutral rate? So what do we do with all of this? Let us start by dismantling a few myths, gently, now that we have the full picture in front of us. The first myth is that a rising interest rate is, in itself, a punishment, a deliberate attempt to make ordinary life harder for the sake of harming ordinary people. As we have seen throughout this history, from the Bank of England's gold defense in the 19th century to Volcker's dramatic intervention in 1979, interest rate changes are a tool wielded with a specific structural purpose, managing the pace of an entire economy, cooling excessive growth, or stimulating sluggish growth, not an act of punishment directed at any individual household. The fact that the effects land unavoidably on real mortgages, real credit card bills, and real business loans does not mean the intention behind the tool is punitive. It means the tool is powerful and its effects are genuinely felt by real people, which is a very different thing from cruelty. It can help, when this fear surfaces, to remember the thermostat we described earlier. Nobody accuses a thermostat of cruelty for adjusting the temperature of a room, even when the adjustment feels uncomfortable in the moment, because the discomfort is understood as a side effect of a broader, necessary regulation, not as the point of the exercise itself. A central bank raising rates is engaged in something structurally similar, adjusting a setting, aware that the adjustment will be felt, often uncomfortably, by millions of people, but pursuing that adjustment because the alternative, allowing an economy to overheat unchecked, risking a more severe and more painful correction later, is judged to be worse. This does not make the discomfort any less real in the moment you are experiencing it, but it does mean the discomfort is a side effect of a broader, deliberate regulation, not the goal of some invisible authority acting against you personally. The second myth is that interest rates are somehow arbitrary, set by whim or political preference, disconnected from any underlying logic. What we have walked through tonight suggests something quite different. A genuinely long, careful, historically tested body of reasoning underlying how these rates are set, refined across centuries of trial error, moral debate, and institutional learning. From ancient Mesopotamian grain loans through medieval religious restriction through the specific documented mathematics of compounding, opportunity cost, and risk that determine every rate quoted to you today. Even the more unusual, seemingly experimental tools we discussed, like quantitative easing or negative interest rates, emerged only after careful deliberation, built on top of centuries of accumulated understanding about how money, lending, and confidence interact, rather than arriving as sudden, untested improvisation. The third myth and perhaps the one most worth sitting with, is the fear that rising rates on your own mortgage or your own debt reflect some kind of personal failure, some mistake you made in taking on that debt in the first place. There is a related myth worth untangling directly, since it colors how many people think about debt in general, regardless of the specific rate attached to it. The assumption that borrowing money is simply inherently unwise, a sign of financial weakness, rather than a normal, sometimes genuinely productive tool. Everything we have walked through tonight suggests a more layered picture. A loan taken to fund a home, an education, or a business expansion is, in essence, an agreement to pay for the use of money now, in exchange for the ability to build something, shelter, skills, a livelihood, years or decades before you could have saved the full amount yourself. Whether a particular loan turns out to be wise depends on a great many specific details of that individual situation, details that are entirely personal and cannot be reduced to a single universal rule. But the mere existence of debt, on its own, has never been the moral failing that anxious late-night thinking sometimes turns it into. Nearly every institution and civilization we have discussed tonight, from Mesopotamian temples issuing grain loans to fund a harvest, to Renaissance merchant bankers financing trade voyages, to modern governments issuing bonds to build roads and hospitals, has relied on borrowing as an entirely ordinary, load-bearing part of how large undertakings get financed. Debt is a tool, priced by the same layered formula of weighting, risk, and inflation we described at the very beginning of the evening. Like most tools, its wisdom lies in how and why and under what specific circumstances it is used, not in whether it exists at all. Interest rates, as we have seen, move according to forces operating at the scale of an entire national or global economy. The neutral rate drifting over decades, a central bank's response to inflation, a shift in the global flow of savings and investment. These forces existed long before your particular loan was taken out, and they will continue long after it is repaid. A rising rate environment affecting your monthly payment is not evidence that you did something wrong. It is evidence that you are, like everyone else, living inside a modern economy subject to a shared structural force that touches nearly every borrower and saver at roughly the same time for reasons that have nothing to do with your individual choices. Let us address a specific fear directly and gently, because it surfaces constantly among people holding a variable rate loan of any kind, watching payments shift as the underlying policy rate moves. The anxiety of not knowing in advance exactly what a monthly payment will look like a year or two from now. This fear is entirely reasonable. Variable rates genuinely do introduce a kind of uncertainty that fixed rates do not, and that uncertainty has a real emotional cost, distinct from the purely financial one. Understanding the mechanism behind these movements, the neutral rate, the brakes and accelerator logic of monetary policy, the historical tendency of rate cycles to eventually turn in both directions, does not remove that uncertainty entirely, but it does transform an unpredictable, seemingly arbitrary force into a recognizable pattern, one that has cycled upward and downward many times before, across many different decades, and has always, eventually, cycled again. There is a second fear worth naming directly, one that sits on the opposite side of the same coin. The frustration felt by savers watching a bank account pay only a modest return year after year, while headlines describe an economy supposedly awash in high interest rates. This frustration is not a misunderstanding. It reflects something genuinely true about how these rates are transmitted through the financial system. A central bank's policy rate moves quickly and directly through the rates banks charge borrowers, since lending is where banks generate much of their revenue, but it moves considerably more slowly and less completely through the rates banks choose to pay depositors, since a bank has less competitive incentive to pass the full increase along to savings accounts it already holds. This asymmetry is a genuine structural feature of modern retail banking, not a personal oversight or a sign that you have chosen the wrong bank. Understanding it does not close the gap between what borrowers pay and what savers receive, but it does explain why that gap exists at all. Rather than leaving it feeling like an unexplained unfairness aimed specifically at you, it is worth adding, too, that this asymmetry tends to narrow somewhat wherever banking competition is strongest. Since a bank genuinely competing for deposits has more incentive to pass along a favorable rate than one operating with fewer rivals, which is part of why savers in different countries, or even different banks within the same country, often notice meaningfully different experiences of this same underlying gap. There is a third fear worth addressing, one that surfaces particularly around consumer debt carried on credit cards, where rates tend to run considerably higher than mortgage or business lending rates. The fear that this kind of debt is somehow a trap, deliberately designed to be difficult or impossible to escape. There is something real embedded in this fear as well. Credit card lending carries substantially higher risk for a lender than a mortgage does, since it is typically unsecured, meaning there is no specific asset, like a home, that the lender can claim if the debt goes unpaid, and this higher risk is reflected directly in a correspondingly higher rate, exactly as the risk layer we described near the beginning of tonight would predict. This does not mean the resulting rate is comfortable, or that the structural logic behind it removes the real financial pressure of carrying that kind of balance. But it does mean the high rate reflects a documented, historically consistent risk calculation, rather than an arbitrary or personally targeted penalty. There is a fourth and final fear worth sitting with, perhaps the quietest and most persistent one of all, the sense that rates only ever seem to move in the direction that is inconvenient for you personally, rising just as you need to borrow, falling just after you have locked in a fixed rate you now regret. There is, alongside this fear, a specific and very common regret worth addressing directly: the discomfort of having locked in a fixed rate shortly before rates fell, or having chosen a variable rate shortly before rates rose, and the nagging sense afterward that a different, better-timed choice was somehow available and simply missed. It is worth remembering, gently, that the professionals who spend entire careers studying interest rate movements, with access to vastly more data and analysis than any individual household could ever gather, have a well-documented and consistent history of also failing to predict the exact timing and direction of rate changes with any real reliability. This is not a comforting statement about your own specific decision, but it is an honest one. The difficulty of timing a rate decision perfectly is not a personal shortcoming. It is a structural feature of a genuinely difficult forecasting problem that has humbled the best resourced institutions in the world again and again across the entire history we have walked through tonight. This feeling, while entirely understandable, tends to reflect something about the nature of memory and attention, rather than something uniquely unlucky about your own timing. Rate cycles move in both directions, repeatedly, across every decade we have discussed tonight. From the gold standard era through Volcker's extraordinary highs, through the extended period of historically low rates that followed the 2008 crisis, whichever direction rates happen to be moving at any given moment in your own life will inevitably feel, from the inside, like the direction they always move, simply because it is the direction you are currently experiencing. The historical record, taken as a whole across centuries, rather than a single lifetime, tells a different, more balanced story. A rate that rises is, sooner or later, a rate that eventually falls again. And a rate that falls is sooner or later one that eventually rises again, in a rhythm that has repeated for as long as recorded lending has existed. There is one more myth worth naming before we move toward the end of the evening, and it concerns a hope that surfaces often, especially after an extended period of low rates like the one many economies experienced in the years following 2008. The hope, sometimes closer to an expectation, that historically low rates might simply become the new permanent normal, freeing everyone from the discomfort of ever again facing a higher cost of borrowing. There is a closely related myth worth untangling as well. The assumption that a rate cut is always straightforwardly good news, and a rate increase is always straightforwardly bad news. As we have seen tonight, a central bank raises rates specifically because an economy appears to be running hot, which, while uncomfortable for borrowers in the moment, generally reflects underlying strength, robust hiring, and confident spending. A central bank cuts rates, by contrast, most often because it is worried about a slowing economy, rising unemployment, or a looming downturn it hopes to soften. This means a rate cut, however welcome it feels for anyone about to take out a loan, is frequently a signal that the wider economy is facing real difficulty, not a straightforward gift. And a rate increase, however uncomfortable in the moment, often reflects an economy healthy enough to withstand it. Learning to read a rate change this way, as a signal about the underlying condition of the wider economy, rather than simply a verdict on whether the news is good or bad for your own monthly payment, is one of the more genuinely useful shifts in perspective that understanding this entire mechanism can offer. What the full sweep of this history suggests, gently but clearly, is that no particular rate environment, high or low, has ever proven permanent. The gold standard era eventually gave way to the volatility of the 1970s. The extraordinary highs of the Volcker era eventually gave way to decades of gradual decline. The historically low rates of the 2010s eventually gave way, in turn, to a return of noticeably higher rates in the years that followed. This is not a discouraging observation. It is, in its own way, a reassuring one. Whatever rate environment you happen to be living through right now, uncomfortable or comfortable, expensive or cheap, is very unlikely to be the permanent, unchanging shape of things to come. It is a chapter in a very old, ongoing story, and every chapter in this particular story, so far, has eventually turned the page. So what do we do with all of this in practical terms? The answer, and this might be the least satisfying part of everything we have explored tonight, is that there is no single answer. The economy is not a machine you can tune with a screwdriver. It is billions of people making decisions every day, and the patterns that emerge are real, but not fully controllable. What we have done tonight is not give you a strategy. It is give you the words, the framework, the understanding you need to make sense of the headlines, to ask better questions, and to sit with uncertainty without it turning into fear. For the rest, the decisions about what to do with your own resources, that is between you and your own judgment, ideally informed by professionals who understand your specific situation. What we have done tonight is give you something quieter, but maybe more lasting, the ability to see the system clearly. And sometimes that is enough. There is a quiet, human thread running underneath everything we have covered tonight, worth pulling into the light before we let this rest. Every interest rate ever charged, from a clay tablet recording a grain loan in ancient Mesopotamia, to a Venetian citizen buying and selling a claim on the Republic's war debt in the 12th century, to a Dutch water authority's thirst for dike repairs in 1648, to Paul Volcker's extraordinary decision in a Washington meeting room in 1979, ultimately rests on the same basic human transaction. Someone needed money now, and someone else was willing to wait for their own money later, in exchange for a little more of it in return. Every layer of sophistication we have added to that simple exchange: central banks, yield curves, compounding formulas, neutral rate estimates, credit scores, sovereign risk premiums, is still, underneath it all, just an elaboration on that same basic ancient act of trust between two people, one who needs something now and one who can afford to wait. It is worth noticing, too, how often this history repeats the same handful of lessons, dressed in different clothing, across wildly different centuries and civilizations. A ruler discovers that changing a number does not change the underlying reality, whether that ruler is Dionysius of Syracuse restamping coins, or a modern government simply wishing rates could be lower than the conditions genuinely allow. A lending system, left unchecked, eventually strains under its own weight, whether the correction arrives as a Mesopotamian debt jubilee or a modern bankruptcy code. A fixed promise, made for a long enough period, eventually meets a world it did not anticipate, whether that promise is a 30-year mortgage colliding with a savings and loan crisis, or an adjustable rate mortgage colliding with a housing downturn decades later. None of this repetition is a coincidence. It reflects the fact that human beings, across every era we have discussed tonight, have been solving essentially the same handful of problems with whatever tools happened to be available to them at the time, learning the same lessons, forgetting them slightly, and relearning them again a generation or two later. What is remarkable is that this pattern, the price of waiting, the price of risk, the price of expected inflation, all folded into a single number, has appeared in one form or another in essentially every society that has ever used money, for as long as human beings have needed to borrow from one another. And suddenly, it all makes sense. Not in the sense that every mortgage statement will feel simple, but in the sense that the underlying shape of the number is no longer a mystery. It is not punishment. It is not arbitrary. It is the price of time itself, measured out in percentages, adjusted by history's hardest lessons, and passed down to you tonight in the form of a number on a page. You are lying there now, in the dark, perhaps thinking faintly of a mortgage statement, or a savings account you have not checked in a while, or a headline about a rate decision you did not fully understand until tonight. The rate is still what it is. The payment is still what it is. But now you know why. There is a strange peace in that, in seeing the pattern, even when the pattern is not something you can personally change from where you are lying right now. Think, for a moment, of that Dutch water authority bond still quietly paying interest more than 3.5 centuries after it was first issued, outliving empires, currencies, and entire political systems, simply because the promise underneath it continued to be honored, year after year, generation after generation. Somewhere, a bond like it may still be quietly accumulating interest tonight, in a drawer or a vault you will never see, carrying forward the same basic, ancient agreement: money now. In exchange for a little more money later? Think of the Mesopotamian scribe, pressing careful marks into wet clay 4,000 years ago, recording a rate of interest on a loan of silver, never imagining that the same underlying idea would still be governing mortgages, savings accounts, and government bonds in a world he could not have begun to picture. Think of the ancient king issuing a debt jubilee resetting the balance between lenders and borrowers, not out of simple kindness, but out of a hard-won understanding that a system left entirely unchecked eventually strains under its own weight. Think of Paul Volcker in 1979 choosing a hard, deliberately painful path because he judged the alternative to be worse, understanding that the number he was setting would ripple outward into millions of individual households in ways he could not fully predict or control, but that he believed, in the end, would leave the whole system more stable than before. Think, too, of the ordinary, quiet moments this same idea passes through every single day, mostly unnoticed. A grandparent opening a savings passbook decades ago, watching a small number grow slightly larger each year. A young couple signing the papers on a first mortgage, trusting a fixed rate to hold steady for 30 years they cannot yet fully picture. A shopkeeper in Renaissance Florence, quietly building an interest charge into the exchange rate between two currencies, careful to stay within the letter of a law written centuries before by people worried about an entirely different kind of harm than the one modern lending regulation worries about today. Every one of these moments, separated by centuries, by continents, by currencies that no longer exist, rests on the same simple, durable idea: money now, a little more money later, and trust holding the space between the two together. The economy is not a natural disaster happening to you. It is a human creation shaped by human choices made across centuries by people solving the problems directly in front of them with the tools they happen to have. And we are inside it, all of us, together, still solving it, still adjusting it, still occasionally getting it wrong, and slowly, imperfectly correcting course. The payment will still be due, the rate will still be what it is, but somewhere underneath the worry, there is now a shape to hold on to, a pattern, a story with real people in it, stretching back further than you might have imagined an hour ago, and continuing forward, quietly, long after tonight. Somewhere, in a city you may never visit, a young analyst is studying Volcker's decisions from 1979 tonight, in a library or on a screen, trying to understand them well enough to help write the next careful chapter of this very old story. Somewhere, a bond issued centuries ago by a small water authority is quietly earning its next payment, indifferent to every war, currency reform, and change of government that has happened around it since. Somewhere, a family is signing the papers on a first mortgage, trusting a fixed number to hold steady for 30 years they cannot yet fully picture. The same quiet leap of faith families have been making since the reforms of the 1930s first made that kind of promise possible. None of this needs to keep you awake tonight. It is simply the enormous, slow, mostly invisible machinery running underneath a single number on a page, a number that once seemed arbitrary, and now, perhaps, feels a little more like what it actually is: the price of time itself, calculated, argued over, occasionally gotten wrong, and slowly, patiently corrected, the same way it has been for roughly 4,000 years. Think back, one last time, to that garden. A single seed, planted patiently, becomes a plant, becomes many seeds, becomes many plants, the growth quietly compounding season after season, whether or not anyone stays awake to watch it happen. Whatever rate is currently attached to your own particular loan or your own particular savings is simply this same old patient compounding process. Wearing the clothing of a modern bank statement instead of a garden bed, the seasons will keep turning, regardless of whether you think about them tonight. And as you lie there, the world continues to turn, Somewhere, a committee is reviewing numbers that will not be announced for weeks. Somewhere, a bond older than most nations is quietly earning its next small payment. Somewhere, a rate is being calculated. On a clay tablet's distant descendant, a screen instead of wet clay, carrying the same ancient idea forward into tomorrow. And here, in the dark, none of it needs your attention. It simply is, as it always has been, as it will be tomorrow.